when everyone is piling into an asset class, you're not, there's a very good chance you're paying a price that's greater than its actual intrinsic value. And frankly, in precious metals, I don't even know how to calculate its intrinsic value. Like I said, it only has speculative value. That's what I call self-fulfilling inflation or inflationary pressures. I think that's where we're at now in the United States. And I just sort of observe it amongst the small business community when I talk with people and I'm watching what's going on, that there's this just idea in their mind, the average person, and they don't think about it in terms of central bank monetary policy or fiscal debt, the sovereign's fiscal debt. They just know kind of like, well, I'm getting charged a lot, so I have to charge the next guy a lot. And like once that sets in, there's an expectation. Like really, the government can't control it anymore. It becomes self-fulfilling. And so that creates an asset bubble, right? It becomes unsustainable. And you see it in America now. You see prices that are indefensible. You couldn't link them to a rational calculus of the money supply.
Okay, ladies and gentlemen, so today we have Father Emmanuel Lemelson on our show, and today we will talk about the US economy, stock market, commodities, precious metals, and many other very interesting topics. So, Father, thank you so much for being on the show.
It's really the privilege is all mine, Vlad. Thank you so much for the invitation. I was so happy to receive it.
Thank you so much, sir. So, we have so much happening right now around the globe, but I would like to focus on US economy first. So, what's your macro take on what's happening with the US economy, and what would be some of the things that you would be paying attention to right now?
Well, generally, at the risk of seeming negative, I feel like our equity markets are completely divorced from reality, partly because of the AI bubble, which is everyone seems to be talking about now, but also because of our regulatory environment has given rise, in my opinion, to almost a golden age of fraud. So if you have any sort of foray into equity markets, you almost have to be like a forensic accountant to figure out if, there's excessive manipulation in the financial statements of a lot of companies, especially in the tech sector and especially around AI. So, that's never good for the economy long run. And then, of course, more anecdotally, if you were in the US, you would probably observe, I'm not sure what it's like in Ireland, but, we've got a very peculiar labor market where people don't really want to work in a lot of industries. And it's a changing culture, a changing society. And I'm not entirely sure of all the drivers of that. I have some pretty good ideas about it, but that also is not leading to greater productivity. So I think there's this transition to how we're going to incorporate AI for greater productivity and efficiency. But we have a whole bunch of people, AI is not really at that level quite yet, but a whole bunch of people who don't feel good about our government or don't feel good about our policies, our economic policies. So we're in a state of flux and a passage from one stage to another. And you wouldn't know that looking at equity markets hitting all-time new highs. And then you have sort of this, gold hitting a new record high of $4,000 in it. I don't think that's so much an indictment of the fiat currency, so much as it is a statement about maybe concern and distrust in the government.
Yes, and if we look at the recent economic data, do you see clear signs of a slowdown and potential for a recession?
Well, the US economy historically has always operated on cycles, that instability of going up and down markets, those permutations generally. So a lot of asset classes are subject to the vicissitudes of the government and its policies. And the Trump administration, I'm not out to advocate a political position one way or another, but it has generally the hallmark of the Trump administrations, the first one and the second one, has been unpredictability, which markets don't like. So I think certain sectors you're seeing quite a bit of fear, like in housing in certain markets, like in Florida, for example, where you're seeing, an increase, I think it was 17% year over year increase in foreclosures. And that does call to mind, it does sort of echo prior crises, like in 2009 during the banking crisis, or in 1929, frankly, if you want to go back that far. So you can see some parallels between prior economic crises where you see the anecdotal evidence beginning to emerge that something's not quite right. And I think when taken as a whole, if you look at this flight to perceived safety, I call it precious metals perceived safety because I don't really think they're safe. And you look at housing, which is a cornerstone of the American economy, that many people, even to this day, in my opinion, wrongly believe it is their greatest or their best investment is their home. And you start to see cracks emerging there. We're not on an swing in the economic cycles. We're probably at the top or on the way back down now on this roller coaster ride. And if you're an American and you've lived in America long enough, you would know that, again, these cycles are really the hallmark of our economy, and they're unpleasant. It's like a system designed for instability, and so you have to know that when you're allocating capital.
Yes, and if you look at these two big forces, we have huge debt levels. We have stock markets valuations that are quite high. So that's deflationary
Yeah.
in a way. But then on the other side, we have the monetary policy when they try to do whatever financial gymnastics they can to avoid deflation, to print. So what do you see between this relationship and which one do you think will win in the long term? Will it be the deflation or inflation?
Well, they are related, keep in mind, Vlad, because to the extent the government and central banks control the currency and the money supply, um, whatever asset class you're invested in, real estate, precious metals, equities, whatever, it's going to be the calculation is going to be done in terms of the currency, right? We still denominate it in US dollars. So the value of the dollar is the means by which we calculate its value on any given point in time, including on a balance sheet. So I think what you're really the more important question, and in terms of what the government wants, the government's always going to want inflation, which is just another word for saying devaluation of the currency, because a debtor government wants to devalue its own debt. And so countries that are not deeply in debt, take Switzerland, for example, where the currency is stable, the Swiss franc, the Swissy. That's a very stable country, stable economy. They don't have this wild swings in the currency or in their equity markets. If you were to buy Nestle or something on the Swiss stock exchange, you wouldn't see wild permutations in price like we see in the United States. And interestingly enough, you see a society of people who are also pretty calm and pretty stable and not doing wild things. So we're a product of our environment, and the government is doing these things deliberately. Again, because it is a debtor country, the government is in debt. It has had the ability, because of the dominance of the dollar, to do that, to take on massive debt. And the best way to dispose of that is to have shadow taxes on the people, and also to simply devalue the currency in perpetuity, because most people won't realize that the devaluation of the currency is in fact a tax on them. So I don't think it's a dichotomy where it's one or the other. I think they're very much so connected, which gives rise to the question of, what's really safe. I think that's the question on a lot of people's mind, and they perceive precious metals to be safe, which is why you see the price of precious metals increasing so quickly. And I think that's a fallacy, a logical fallacy.
Right. And if we, so on a big level, the governments, the only way they can really get away with the debt levels is to continue to print. So on a big picture for the long term, do you just see continual currency devaluation and increase in asset prices? Because some people believe that we could have this huge asset crash that can last for, let's say, a decade. So which camp would you be in?
Well, the MO of the U.S. government, as evidenced by historical fact, is that they constantly increase the money supply and devalue the own currency. So I'm not sure what reason there would be a rationale to suggest the government would do otherwise, especially with the debt levels we have. And we talk. You might know this, but we talk a lot about this on our Substack. I don't know. I'm sure if you follow, we publish a lot of articles on this, on what constitutes real safety. But could there be an asset crash? Absolutely, because at some point, inflation becomes self-fulfilling, and I think that's where we're at now. Excuse me. And when we during the pandemic, when we saw this massive injection of liquidity, I remember telling anyone that would listen that inflation would ultimately get out of control in terms of the ability of a central bank to contain it by money supply alone, because eventually people would simply expect that the price of everything should go up because they were being charged more and they have to charge the next guy more. So that's what I call self-fulfilling inflation or inflationary pressures. I think that's where we're at now in the United States. And I just sort of observe it amongst the small business community when I talk with people and I'm watching what's going on, that there's this just idea in their mind, the average person, and they don't think about it in terms of central bank monetary policy or fiscal debt, the sovereign's fiscal debt. They just know kind of like, well, I'm getting charged a lot, so I have to charge the next guy a lot. And like once that sets in, there's an expectation. Like really, the government can't control it anymore. It becomes self-fulfilling. And so that creates an asset bubble, right? It becomes unsustainable. And you see it in America now. You see prices that are indefensible. You couldn't link them to a rational calculus of the money supply, And when you look at that, you say, well, it's completely unsustainable. It's just horrible for the economy and it's detached from reality. It's making the currency look like a joke. And and you look around in other parts of the world and you could literally go and live somewhere else and have like cost of living arbitrage where you would have, you see this with the digital nomad community where they're working remotely, they're living in another country where they don't have that problem. And you look at it and say, how could it be that something that should be valued at X, like $5, is being sold for 15, and you can't connect it to any um, rational calculus of what's going on in the economy. And then you have a bubble that's created by mass speculation. We call it the madness of crowds, you could say. And I think that's what happened in Florida real estate, for example. Now you're seeing it crack. So yes, can asset prices go down? Absolutely, and they will. And I think that will happen in many, many sectors, not just real estate, and probably precious metals as well. I think for people who are feeling really smart right now because they've made a killing on precious metals, I think it's very much so subject to a crash.
Right. And you have mentioned that you do not believe that precious metals are safe. If we could expand, if we could go deeper into that and
Yeah.
talk about how you view this whole sector.
Well, I've often said that, precious metals, it's something that we dig up from the ground, we melt it down, and we dig another hole in the ground and put it in there, And it has no real productive value of its own. It only has speculative value. So when you own gold or silver, it's almost like the greater fool theory. You're like, who's willing to pay even more? If I paid $4,000 today, will someone tomorrow pay $4,100 for it? It doesn't have a balance sheet or an income statement. It's not really productive. It doesn't have intellectual property. And to think that it's safe from, again, the vicissitudes of the political administration that's in power at any given time is incorrect. It is absolutely subject to changes in monetary policy and government policy. And as an investor, generally you want to be buying things that, in my opinion, that are not widely understood or widely loved or followed. And when everyone is piling into an asset class, there's a very good chance you're paying a price that's greater than its actual intrinsic value. And frankly, in precious metals, I don't even know how to calculate its intrinsic value. Like I said, it only has speculative value. If you're looking at equities, for example, which is what we write about in our Substack quite a lot, is we're looking at almost in a forensic way, right? Because we believe there's a lot of fraud in the market right now. So we'll be looking at a balance sheet and saying, what's really the assets of this company when you get a share in it. If you buy a share or you buy 100 shares, 1,000 shares, you're owning a piece of that company. It's a productive asset, meaning it's throwing off free cash flow. And it could have, X profits or Y profits, it's operating profits, it's net profits. And what are the actual assets the company owns and what am I paying for it? So what am I paying for the assets the company already owns? Usually we're looking for tangible assets. And then what's the future value of its free cash flows? So a lot of the companies we buy, we'll look back 15 years or so and we'll look for consistent earnings and consistent free cash flow. And then we can do an actual calculus. We can say, well, it might go down in the future, but if they haven't had any negative showings in the last 15 years, if there hasn't been a deficit, a reported deficit, and they've got growing retained earnings, owner earnings, let's say, like the equity in the company is the equity that belongs to the owners of the company, which is not the management teams, the shareholders, then that, in my mind, is much safer than the greater fool theory, which is I can pay any price today because someone will pay a higher price tomorrow. I talk to people who own gold and silver all the time, and they think it's great, the greatest thing in the world. All these podcasts are very successful that talk about gold and silver because it's like a social mania. But nobody I've talked to can actually describe to me how to calculate its intrinsic value. Again, only speculative value. To me, that would make me very uncomfortable. I'll give you a great example. We own a company called Flower Foods. They make Dave's Killer Bread. You may not have it in Ireland. I'm not sure. We have it in America. It's really a wonderful bread. I love the product. It's a all natural, organic, non-GMO. It could not be more boring. I mean, it's the most boring thing. It's never going to be talked about on CNBC. No one's going to get excited about it. But when the market fell 900 points on Friday, Flower Foods was actually up. So when there was, let's say panic setting in on last Friday with the market sort of beginning of what seemed to be like a market correction, that was one of our largest holdings and it's paying a dividend. But we know exactly what we own and it's not like everyone's rushing in to buy it. So, that's how I feel about precious metals. And I just think it's speculative. Like it's like buying Florida real estate a year ago. Like everyone's rushing in. And when it's red flashing lights on CNBC every day talking about it, there's probably a very good indication that you're buying a bubble, frankly. Nobody on CNBC or Bloomberg or anywhere is going to give you, out of the goodness of their heart, the next great investment idea. So if somebody's talking about something all the time and there's massive groups of people talking about it all the time, it's again, it's not because they have the Mother Teresa philosophy of capital allocation. They want to help people out of their great charity. It's because they want to build a bubble. And a lot of people are going to make money off the building of those bubbles.
right?
And other
And
people get stuck holding the bag. Sorry, go ahead, Vlad.
so if we look at the commodity sector, things like copper, uranium, and some of the other things, what would you be interested in the sector, or will it be similar to precious metals?
Well, copper might be a little different just because it has utility, not unlike the rare earths. So you could say, well, there's a supply demand equation in copper that's ongoing, or in rare earth, certainly. I mean, if you look how widely, used rare earth materials are, especially in so many critical sectors. But I think that has to do with more of analyzing the companies that mine it and refine it than it does the actual commodity itself. So I
Mhm.
would be looking at the companies, and then there will be companies undoubtedly in the U.S. that probably again almost you need to be like a forensic accountant to figure out which ones are riding the wave of a bubble and which ones actually have real intellectual property and a competitive moat. Like some refiners will truly be efficient in their production, not only their mining operations, but their how they refine these rare earth materials and so forth. Or if in the case of copper, could be the same thing. But you're really at that case, you're looking at again the productivity and the efficiency of the company involved with refining those commodities. Gold and silver is a little different because they're not that widely used in electronics and so forth. There's some use of them, but generally they're just viewed as safe haven assets for as an offset against a fiat currency. But if you're really worried about a fiat currency, you could just buy a safe haven currency. For example, you could buy Swiss francs, which is a very historically safe and stable currency.
Mm,
And in my opinion, you wouldn't be subject then to the unpredictability of our U.S. government.
The mining stocks, they do look very interesting if you look at copper, because I'm personally very interested in that sector. If we look at the underinvestment in copper over the last few decades and the future demand that we can, I suppose, predict in a way, those some of those equities still look very, very undervalued as if you look purely at the business model. And of course, it depends on the price of the commodity, but
Yeah.
even at the current levels, I believe there are a few opportunities as well. And so just on some of the sectors that you would be interested in right now, if you could talk about that.
Well, we actually do. We publish this Substack now. It's kind of a nascent Substack. We've started just maybe a month or two ago, but it's been very popular. And we really dive in an academic way, Vlad. We want to be like the anti-speculators, if you will. We want people who read the Substack to be able to go to bed at night and understand what we're buying and why we buy it, and why we don't lose sleep at night based on price permutations. So in general terms, Vlad, price is what you pay like for one of these copper miners, for example, and value is what you get. At the risk of sounding overly simple about it, you have to be able to read the financial statements of a company to understand what you're getting, the value you're getting. And then I would add that in a current environment, you have to be almost forensic in your approach because it's a very, very lax regulatory environment. So, you know, if you're not familiar with reading a balance sheet, a statement of cash flows, and an income statement, you should get up to speed on that because that's really the only way to know what you own. And I talk to people all the time. They get this in other asset classes. They get it with real estate, for example. Like if they're going to buy a home, I'll tell them before you bought this real estate, you probably researched like the neighborhood, the crime rates, the school system, the building materials, like how old the home was, how many square feet, blah, 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 blah. They say, oh, of course, we did all that. I'm like, okay, and you bought Home Depot stock. And what is their equity? And they're like, what? I'm like, well, do they pay a dividend? Huh? Like they're confused. Like it's weird. It's like when people move to tradable assets that are highly liquid, because that's really what they are, they lose like 50 IQ points. It's the weirdest thing. I never understood it. Like really smart guys too, like guys who build successful businesses, and they're just shrewd in every sense of the word. Like I have a lot of friends that are billionaires, and they like I have to walk them through, hold their hand on like reading financial statements and equities, and they're counting on some advisor to give them advice, which isn't really advice at all. It's a sales guy, who kind of presents himself as an allocator. So they make all these wild allocation decisions and that are not based on very intelligent thinking. So in terms of the three financial statements, you've got an income statement, which is the most widely understood probably, but also the most fungible. It's the ones that can be manipulated the most easily. That's why you see EBITDA earnings and all these other weird metrics that kind of get made up to make the earnings look better than they are. Then you've got the balance sheet, which is less capable of being manipulated, but still you could have some manipulation. You could have, for example, you can have all sorts of intangible items on a balance sheet that have purported value, like intellectual property in certain sectors, like the pharmaceutical industry. They get away with that a lot. They can pad their balance sheet. You've probably heard that expression. And then there's the statement of cash flows, which cannot be manipulated at all without fraud. So you look at them from like least manipulatable to the most manipulatable, and it doesn't take that long. The basics one to read financial statements. So like in the example you gave of the copper companies, I would just look at those names if I were you, and walk through and try to figure out, what's the real true intrinsic value per share, not just based on its current assets, like tangible assets, but the value of its future cash flows, which will run to me as an owner of the shares. And once you get your hands around that, then you can really figure out, is the price I'm paying higher than that value or is it lower? And our philosophy, of course, and we walk through this in the examples on our Substack, our philosophy is that if you can buy a dollar bill for, say, 50 cents, for example, you have what we call a margin of safety. So let's say you have this copper mining company and you figure out it's worth $10 a share based on its discounted future free cash flows, which is the value of, let's say, the cash flows over the next 10 years minus a risk-free rate. Let's call it the S&P's performance, historical performance. And then you add in, let's say, its tangible assets. Now you've got an intrinsic value for the stock. Well, it's going to be black and white if it's over or under the price. And if you can buy it one day because copper mining companies happen to be very unpopular because the Trump administration announced a new policy or something happens, the market crashes, everything gets brought down, you should be able to put money to work very aggressively and still sleep at night because you know that you're buying a dollar bill for 50 cents with this margin of safety. So what's the margin of safety? It's the delta between the price you're paying and the value you're getting. So let's say the stock is worth a dollar, you paid 50 cents. Now, you could be wrong in your appraisal. You might have overlooked something. You're human. Fine, happens all the time. Maybe it's not worth a dollar. Maybe it's worth 80 cents or 70. But if you only paid 50, you still have, let's say, 40% upside at 70 cents. That's a very, very different philosophy of investment and approach to capital allocation than speculation. And I'm not aware of how someone can do that with gold or silver. Unless you're looking at the miners, for example, in which case, again, they're probably going to be subject to the price of the underlying commodity, which is subject to the policies of a government. So you would want to find fortress companies, right, that have long histories of free cash flow, compounding their owner's equity, which is what you actually own, the security interest in the shares, no deficit in their earnings over the last, say, 10 years. They have probably a remarkably boring product, are paying you a dividend, and are not going to be subject to the vicissitudes of the administration. If you can do that, like that's like shooting fish in a barrel. That's like almost no risk. And you could probably get 20% returns doing that over a pretty long period of time. Let's say if you looked at 5 or 10 year cycles, guys can get 20% doing that a year. Now, if you're compounding at 20% a year, even a very small amount of capital is going to grow to a very large amount of capital. And you don't have to go to bed at night wondering, when the next government policy is going to shift and it's going to throw the price of a commodity out of whack, oil and gas, whatever, gold, silver. You've got an actual productive business with a long operating history and a dynamism that comes with a business that doesn't exist in a precious metal, if that makes sense.
Oh,
Long
100%.
answer, I guess.
And I think there are very few companies in the commodity sector that can be considered as an investment. Most of them are speculation because they're either building, they're drilling, there's so much risk, there's different countries and everything. So, and I think that's why it's important to use a bucket approach if you are speculating, because just picking individual companies and putting all your capital in that is very,
But
very
but why speculate?
sure. That's a good question, but I suppose some people
They
are,
can't help themselves.
yeah, they can't help themselves, but they are like I interview a lot of successful speculators who spend most of their life
Are they?
speculating.
Are
Yeah,
they really
look,
successful? I mean, are any of them on the Forbes 400? I mean, I have yet, and I've been in this business for a long time, Vlad, before I was a priest. I haven't met a single speculator that's successful over a 10-year period of time. Have you?
I think I have, yes.
Really? Well, I'd love to meet them sometime. Because to me, speculation is a synonym for gambling. Like there's no successful gamblers in Las Vegas who have like a storied 20-year career. The house always wins. Speculation, it means the etymological root of the word in Latin is to see into the future. Like we could get the word spectacles from it, like to be able to see clearly. So to be successful as a speculator, you'd almost have to have like prophetic powers. which we don't have. That's the bottom line. I mean, I think the greatest investment is the most humble investments. And that's why the speculator's mindset isn't if I can buy a dollar bill for 50 cents. The speculator says the inverse of that. He says if I have to pay $1.50 for a dollar, that's okay because tomorrow it will be worth two. So he has the inverse. He thinks he knows, but in reality, he doesn't really know. Now, can investors have some hits here and there? Sure. And they always rely on those one or two hits. That is not unlike, gamblers get addicted to gambling because they almost in every case, if you look at the psychological studies of people who are addicted to gambling, they have a win early on and they get this like dopamine high and they get excited by it and then they can't help themselves. And as you know, people who are gambling addicts wind up bankrupt every time. Their marriages are in ruins. Almost every speculator I meet is somewhere along those lines. They're treading water in terms of their returns, and that's why the speculators never start their investor correspondence or their publications with their track record up front. Their long-term track record,
Mm.
maybe a short-term track record.
So the way I'm talking about speculation is, for example, if you want to invest in a certain, let's pick gold as an example, and there are, let's say, 20 exploration companies that you have chosen from the bucket of 100 or 200, and you believe they are more likely to perform better than the others because maybe you have a certain geological edge or whatever you may
Sure.
be. So I suppose my point would be that you are choosing those 20 companies, and sure, half of them or maybe more will fail because that's the nature of the business. But if you have a certain age, some of them will do well, and that's how you would make your money. I suppose that's how.
Yeah, that's like the venture capitalist mindset. They'll invest in like 10 companies, expect nine to fail, and then the one that succeeds so radically it more than offsets the losses on the other nine. Not my place to judge. I would just say, why do that if there's a better mousetrap? You know, I'd rather just understand what I'm actually getting and knowing that it's worth more than I'm paying and that there's no risk. I guess that's just my personal preference. But, if you're talking about the actual, not the underlying commodity, which is, it can be very volatile. You're talking about the miners or these companies. My advice would just be to the listeners that, don't do diversification for the sake of diversity. So like you said, you can identify X number of companies, just find the best ones with the longest track record of earnings, the best operating margins, the best net margins, the best intellectual property. And then in terms of once you've looked at, the qualitative issues, which are the financial statements, move over to the quantitative issues, which are the financial, then move to the qualitative issues, which is the management team. Like you said, any particular approach they have that's differentiated and you have a fairly high degree of conviction, it's going to give them a competitive advantage or a moat over their competition. And then once you narrow that down, just choose the best of the class of the industry. And I would do a comparative analysis of the qualitative and the quantitative issues, and then you're left with the very best in that industry.
Yes, that's a very, very good point. So I like to ask this question for the younger audience. So if we have an individual who's still at the beginning of his and hers well-building path, they have so many options now with the cryptocurrencies, the AI, absolutely everything. So what advice would you have for that individual when they're still very new, they don't know much, have so many options, so that they don't make too many mistakes and don't get burned too much?
Well, read the Father Emmanuel Lemelson Substack religiously. No, just kidding. That's a shameless plug. I would say to the young people, actually do read some of those articles or articles like that talk about understanding the value of what you own. Knowledge is power, Vlad. And if you have a lot of knowledge, you really can't be taken advantage of. When you go into markets, it's a shark tank. Nobody's there for charitable purposes, right? Nobody has your best interests at heart. Everyone's trying to make a buck. At its core, it's pretty ugly, actually. It's driven 99.9% of the time by greed or fear, two emotions that you really don't need in your life. You don't have to be that way as a young person who wants to grow your wealth. You don't have to be driven by those ugly emotions. And I would say, again, learn the basics of accounting, learn to read financial statements. If something, in my opinion, has the word crypto in it, which means secret, I would just stay away. I like transparency personally. I think financial markets should be predicated on transparency. If you cannot understand the value of what you're getting for what you're paying, move on. Like if you start reading the financial statements of a company or you start listening to a quarterly report and you just don't know what they're talking about, it's not because you're dumb. It's not because you're not a good business person. It's because they don't want you to understand and move on. You're going to probably succeed based on all the things you say no to. So stay away from the really complicated ones, the opaque ones, the ones where the waters are muddied, the ones where there's a lot of catchy and exciting keywords in it. Like in the name, it could be in the name of the company, it could be in the way the CEO is talking about it on a conference call. If it's all about selling the issue with great confidence, just remember that the word con man comes from confidence man. So if you're listening to the principles of the company or the whatever, it's a lot of confidence building about how great their company is. They have to sell it hard. I would move on. Great companies don't need to be sold all the time. Um, so I would really encourage people to look to the great investment thinkers in history. Go all the way back to Aesop's fables, frankly. Start there. That will tell you something about human nature. And then I would, jump forward a couple thousand years to the work of Benjamin Graham in modern markets. And he was the dean of Wall Street, the mentor to Warren Buffett. He has two seminal works, The Intelligent Investor and Security Analysis. Then I'd move on to the essays of Warren Buffett. And, all this reading could be done in like a week, maybe 2 weeks. It's okay to sit on your cash that long. You're not going to miss any great opportunities while you're reading and getting up to speed. And if those things seem to make sense to you, I would just stay away from the crazes. To me, crypto and gold and all this, it just looks like the tulip mania, tulip bulbs. People are paying the same amount as a home cost for a tulip bulb to show you the madness of crowds. I was just now thinking this morning about the pyramid schemes in Albania. I don't know if you know anything about it. You may or may not know about it, but in the 90s, this tiny country, Albania, all these pyramid schemes were launched. And the average Albanian, which was not a wealthy family, it's a poor country in Eastern Europe, they were mortgaging their home, selling everything they owned to invest in pyramid schemes that they had no clue what they were buying. So one of the rarest things, Vlad, is the ability to think independently. Most people will get caught up in manias, social manias. And of course, in Albania, everyone lost everything. You took a poor country, you just made it so much poorer. And the architects of those pyramid schemes, they fled the country. They walked away quite well. I'm sure they're in Portofino or something enjoying their yachts. You know, the the housing bubble of the mid 2000s was very similar. The architects of those were frauds, walked away very, very wealthy while it destroyed the life of many blue collar Americans and others who participated in it, believing that if they just went where everyone else went, that it was going to be the pathway to their God-given right to be rich. And it's just a story as old as time. You just have to read a little bit of history to see how misguided that is. And so that's my advice to young people. Gain knowledge. Knowledge is power. Stay away from speculative bubbles and social manias. Um, Nobody's going to give you advice out of the goodness of their heart on Wall Street. Do your own homework. Do common sense things. You're probably going to say no a lot. Buy things you understand and buy things where you know the value is greater than what you're paying. And if you do that, you're going to get better than average rates of return, in my opinion, and you're going to compound and you'll grow to fiscal independence and financial independence over time, and that will be okay. If every day you're getting a little more independent and a little bit wealthier, then that's okay. You don't need to get wealthy overnight trading, some sort of derivative on gold on your Robinhood app or something like that for an IPO. It's just you don't need it. That's my advice.
Yes, very, very good advice. And I think also the importance of having a mentor is quite important. And I'm sure you could be that mentor for a lot of people with the great
Well, sorry, go ahead, Vlad.
with the great value you have on your Substack.
Well, I really appreciate that, Vlad. It's so true. Mentors are life-changing. I had a very amazing mentor. He was a priest. In my opinion, if I could just say a little bit more with young people, I would say, don't make your life about building wealth. It's okay to be wealthy. Nothing wrong with that. There's nothing wrong with money. And it's when you're a young guy, you're ambitious. You want to go, or a young woman, whatever. You want to be ambitious and create great things. That's okay. Use your talents. God gave them to you for a reason. Use them. I'm not saying to be like a monk. But there are so many darn beautiful things to live for that don't involve blinking red and green lights on a screen. Don't miss out on life on account of those things. If you're young, you'd be thinking about the beauty of, married and family life, the love of a child, travel, go see the world. Do lots of great things in your life. Don't get sucked into the the devil's lair of, obsession with materialism and wealth. Because honestly, wealth in and of itself is nothing but false promises. It's all smoke and mirrors. Like I told you, I got a lot of super wealthy friends, and I don't know a single one whose life was improved by having more money. And so, look for the things that are not material. Don't think that the material things of this world are the most real. The most real things are the ones that are transmaterial, they're immaterial in your life. And if you look at, and again, this is ancient wisdom, right? This is not coming from Father Emmanuel. The ones who just get stuck at pursuing those things, it leads to a lot of unhappiness and a lot of lack of fulfillment, a meaning crisis, that kind of thing. So do it, keep it in perspective, do it wisely, and perhaps most importantly, remember the good you can do with your successes. Should you have successes, remember that the talents you had that created that success, you did not give to yourself. God gave them to you, right? I mean, you didn't give your brain to yourself. You didn't give your intellect to yourself, your ability to grow your knowledge. You didn't give that to yourself. So if you didn't give it to yourself, maybe it wasn't meant for yourself. Maybe it was meant to share with others. And to the extent you can use your talents, your God-given talents, and your success to help others, do it, because then you'll find great meaning, and you'll also be set free to do more of it and multiply your talents and your successes, and it will just be a whole different experience than the sort of dark places Wall Street will take you if you look at that as an end in itself.
100%. So, sir, these are all the questions I had. Is there anything else maybe you would like to mention that we haven't covered?
Well, Vlad, I'm just so glad to have been brought on your show, and I think you do a tremendous job. I follow your program. I hope everyone listening does as well. And we need more commentators like you who are thoughtful and out there to get to the truth and seeking the truth and to gain that important knowledge. So I just want to thank you for everything you're doing and you're giving to the world and contributing to educating the world through your own means, which is this podcast.
Thank you so much, Father Emmanuel. I really enjoyed this conversation and I hope to have you back on the show.
Absolutely, I did as well. I look forward to doing it again sometime, Vlad. Thank you so much.